Welcome to Retiring Well, where it's our job to help you enjoy financial security in any economy. We've got a great show lined up for you this week. We're talking about this thing called return sequence risk. What the heck is that? And why do you care? That's what we're going to answer in today's very important show. So sit back, relax, and enjoy the show.
Retiring Well, providing financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your money forever. Retiring Well, featuring retirement planning specialists Robert Russell and Curvin Miller of Russell & Company in Dayton, Ohio.
Sequence of return risk. That's our topic for today. But before we get into that, like I like to do every week, I want to share with you why we do this show. I mean, we really believe that the messages you're receiving are not appropriate if you're retired or if you're going to be retiring in the near future. All those messages you get today from the mass financial media, it comes from the big Wall Street firms, the big banks, the big financial media. And it's terrific if all you're trying to do is grow a portfolio. But when you're getting closer to retirement and you enter into retirement itself, these messages can be devastating. We want to help you get a different perspective on the way you invest during your retirement years and during those years when you're getting close. So that's what we are aiming to do in these shows. Now, let's talk a little bit about return sequence risk or sequence of return risk, however you want to name it. What this is, and this recently came up in a Market Watch article, so that's why we're talking about it. It's the question is, in what order do you get returns when it comes to your stock market portfolio, the parts of your money that's in the market? Do you get good returns in the early years? Do you get bad returns in the early years? Guess what? It matters. It matters when you're building a portfolio. It matters even more when you're getting ready to retire and during retirement. So that brings up our topic of the week. All right, I'm here with Robert Russell and Curve Miller with Russell & Company there in Dayton. And guys, I know that you're extremely familiar with this concept known as sequence of return risk and how it affects folks, whether it's in the accumulation phase or when they're retired and they're trying to take income. So what I'd like you to do, if you don't mind, is kind of take it away from here and share with our audience what it means to them.
Thanks, Mike. This is the most important thing we can talk about in retirement. Income planning in retirement is what it's all about. You saved all this money to get to this point right now, and the sequence of returns is absolutely critical. So if you start off, if you retire and happen to lose a bunch of money in the stock market, you're at a disadvantage. Because it's about not running out. That's the number one question we get. Do I have enough money to make sure I don't run out of money in retirement now that I don't have a paycheck coming in every 2 weeks? So the sequence of returns is absolutely imperative.
Yeah, and don't forget, when we're talking about sequence of returns, that's just a phrase, a description for uncertainty, because we never know what kind of market cycle we're about to enter, whether it's a bull or a bear or just a sideways market. You never know. And listen, when you're putting money into your investments, like your 401ks, your TSP, your retirement accounts, the sequence of returns, for instance, whether you have a +8, a +8, and a -8, or you start with the -8 first, +8%, +8%. That's the sequence. It's not as big of a deal when you're adding money to your accounts. But when you stop adding money to your accounts, you retire, or worse yet, you start to live off of your life savings. It's like taking the shocks out of your car. And you're going to feel every bump in the market in those sequence of returns. That's how people run out of money in retirement.
Well, people also forget, too, that if you take a loss in the stock market, you have less money to now compound on. So if, I used to do this, my wife is a teacher, and so we do new math. And so if you lose 30% of your portfolio, what rate of return is required to get you back to even? Well, the answer is you have to make 43% to get back to zero. If you lose half of your account, 50%, And people used to laugh when we talked about this.
Yeah.
And this was before 2008.
Yeah.
If you lose half of your portfolio, you have to make a 100% rate of return to get back to zero.
Back to even.
Back to
Let
even.
alone taking income from it.
Exactly. So if you are relying on your savings for income, which most people in retirement are, you're probably no different. Think about this. If you take a loss and you're taking money out, you're compounding that loss. It's harder and harder and harder to get back above water.
Well, let's face it, the solution for this, the traditional solution, the Wall Street brokerage house, wirehouse solution, is to just lower the volatility in your portfolio. In other words, add bonds to your stocks. So a balanced portfolio of stocks and bonds. What many people call the 60-40 portfolio. Well, listen, Morningstar did a recent study on the 60-40 portfolio. And what they found was, if you need to live off this money in retirement, and you have a stock bond portfolio, in this environment where bonds aren't earning squat, and bonds and stocks have highly become correlated or coupled, you have basically a 50% probability of running out of money in retirement. A coins flip chance.
Wow.
If you're living off of 4%, there's the old standard rule from the Wall Street brokers and mutual fund companies. Take out 4% a year, invest it in the market, invest it in bonds. You shouldn't run out of money in retirement. Well, that is some dangerous advice according to Morningstar. You have a 50% chance, a coin flip chance of running out of money. They suggest, instead of taking out 4%, to take out 2.8%, and your odds go up significantly. 2.8. But hey, what if you needed that 4%?
Right.
What if you need more income than just 2.8% cash flow from your retirement savings? That's a problem.
Yeah, and that's the thing, is that so many people have been told for so long, Rob, that stock bond portfolio, keep it diversified, you'll be fine. So now we understand that with interest rates at 30-year lows and bond prices at 30-year highs and all this stuff and this coupling and this correlation, where do people go? What do they do? So we have to find investments that are not correlated, things that will actually help and protect you from inflation when you need income. Maybe that, having some type of an account that will guarantee an income stream, something. You've got to have a plan, and stock and bonds not that plan.
Yeah, a strategic income plan, and stocks and bonds, that may be part of it, a segment of the plan. But really, we need to look at ways to craft it so you don't run out of money in retirement to generate more cash flow than 2.8%. Wouldn't you agree?
Yep.
Listen, if you're in that stage where you're about to retire, or you're retired and you need to live off your life savings and not run out of money, give us a call. We'll sit down, see if we can help.
My goodness. Did you hear that information? I mean, think about it. Here you are doing everything the way you're supposed to do it. You're saving money for your retirement, or maybe you're already retired and you're taking income. And how much money you have at the end of the road could vary tremendously based on what? Something that you don't control. And that is the order in which the market has its returns. Does it have good years early, or are there bad years early? It matters when it comes time to building your portfolio. And then did you hear the numbers when it comes to taking retirement income? That depending on when you retire, you could take anywhere from 1.9% to 10.9%, and none of that's in your control. It's all based on when you retire, and you have no idea what's going to happen in the future. Folks, this is why I keep telling you each and every week, talk to a retirement advisor, someone who specializes in this area. And all you have to do, call the number on the screen. It's not that hard. I encourage you to do it now. Now, don't go anywhere, because coming up, you're going to hear some real life stories of how the sequence of return risk affects people just like you and me. Hi, my name's Michael Reese. I'm a certified financial planner who specializes in retirement planning. And for the last 18 years, I've been helping my clients enjoy financial security during their retirement years. And one of the hottest financial tools out there right now for retirement planning are annuities, but they're also the most misunderstood. And it's really no surprise why things are so confusing, because both the insurance companies and the financial media do such a poor job explaining what annuities are and when they should best be used. That's why I've created a series of videos absolutely free that you can watch in the comfort of your own home to teach you what annuities are and how they work.
Visit www.makingannuitiessimple.com today for a free video series with TV host and retirement planning strategist Michael Reese.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Russell & Company is one of the area's premier retirement planning specialists. For a complimentary consultation, call 1-800-392-4378. Russell & Company, helping you create a winning strategy.
Welcome back. So this week we've been talking about this concept known as sequence of return risk. And it can be pretty frustrating because here you are doing everything you're supposed to do. You're setting money aside for your retirement. You're trying to grow a nest egg so someday you can be financially secure. And the problem that we have is you have no idea how much you're going to have when you get out there towards retirement, because it's outside of your control. How the market has its returns, the order in which those returns come, make all the difference in the world there. For your success or failure, again, you don't control that. Same is true when it comes time to take income after you've retired. Well, Rob and Curve, I know guys, you have some stories to share of families that were affected directly by this concept of sequence of return risk. So why don't you go ahead, take it from here and share those stories with our viewers.
Mike, have I got a story for you? I will never forget this. But I met a gentleman back in 2009, later in 2009, and he had at one point $700,000 saved. And of course, he was subjected to losing about a third of that in the correction back in 2008. And so it left him with about $475,000. Now, his income needs were $72,000 a year. He had to have $72,000 a year.
Wow.
All he had to supplement that was Social Security. So that means everything else was coming off of his investments. And you think about this, when you have that kind of an income need and you take market losses, what's happened is it really increases the withdrawal rate you need. I mean, his withdrawal rate up over 10%.
Yeah.
And so we're handcuffed. There's not much that we can do. We're good. We're not that good. But there's certain things that you can't do. So it's so important. I'll never forget that, because not only did he have a house that he just purchased out west that was underwater. Okay.
Really?
It was in Arizona.
It was literally underwater?
I don't know how it's underwater in Arizona, but it was on a golf course, I guess.
It would be hard to play golf underwater.
I think so too. But 2 houses, all these fixed expenses. He had insurance premiums of over $20,000 a year. So you think about this, of his 70, 20 of it was going to insurance. We have to have a really tough conversation about what is really important. There's got to be sacrifices made, or his viability, or he's going to run out of money very soon if he doesn't change something. And that's the key, is that I don't want you to feel handcuffed if you're watching this right now, is that you have to have some kind of a plan that says, look, I'm not going to run out of money, at any point in my retirement. Realizing that going back to work may not be an option. Most people don't want to do that. You've retired the first time. You don't want to have to go back to work. And so actually having a plan, having appropriate risk in retirement, and having an income plan is what it's all about in retirement.
So he had to go back to work.
I don't know if he
extend his working years.
At the end of the day, that's kind of the way our conversation went. Is that I don't know. I haven't seen him for years at this point. But the way that conversation, and I don't like the way that conversation ended. I felt bad for him. I really wanted to help give him a plan, but it's tough because the income rate that he needed was unsustainable.
You can't argue with math. I mean, math is infallible. You may be thinking, listen, I'm investing for the long term, without realizing it's actually gambling. It's gambling with your lifestyle, gambling with your income in retirement. Just like this gentleman going from $700,000 to $475,000. There's a 100% probability that the market will crash at some point in the future. 100% probability it will crash. We just don't know when.
Right.
So when it comes to securing your lifestyle, when it comes to securing your income in retirement, you don't want to take that kind of risk. Doesn't mean risk is bad. It just means don't risk your lifestyle. Don't risk your dreams for retirement. It all comes down to making sure you have a dependable retirement income plan that's protected from inflation, that's protected from the whims and whipsaws of the market, and that kind of thing. If you're 20 or 30 years old, go ahead, go all in, right? That's going to be the best wealth creator, most likely, in your younger years. But if you're in that retirement red zone, like so many of our clients and prospective clients, that they're 5, maybe 10 years out into retirement, or they're actually in retirement, it's too serious. We can't bet the farm.
Right.
We have to secure it, or at least secure the piece that is sacred, so you don't run out of money. It's like the old rule of the golden goose. You never kill the golden goose, and you protect it, because the golden goose lays the golden eggs, and the golden goose, in your case, is your retirement savings.
When you think about it, companies themselves are broke. Well, they're not broke, but they're not paying for pensions anymore. I mean, pensions are the new dinosaurs, so you're on your own. What you save and what you do with that golden goose is going to determine your future. It's more important than ever. The 21st century is about Americans taking control of their financial future, because we look around and the role models we have are the government. They don't have any money. And the companies aren't paying for pensions. It's up to you. Make smart decisions. Sometimes, life is about moderation. It's about balance. It's about sacrifice. Sometimes we don't like what makes us successful. You don't like how you get there, but sometimes you have to take a piece of what you took a lifetime to save and protect it and do something and make sure you have an income plan from it. So if you've never sat down with an advisor who can help you craft an income plan, maybe today's the day. Give the number at the bottom of the screen. Rob and I would be happy to sit down with you and discuss your options.
Rob, Curve, fantastic stories. I think the one I like the most is the one not where there was success, but the one where there was failure, because we always learn from our failures. That story where the folks didn't get to you in time, and because they didn't get to you in time, 2008 devastated them. They had to work longer than they expected. And that's just a shame, because had they done the right thing, had they met with you on time, it wouldn't have happened. Well, folks, it made me think, what about you? What about you? The markets have been doing well the past few years. Everybody's feeling good. It's exactly the right time to sit down with Rob and Curve. Call the number on the screen. Leave your name and number. Their team will get in touch with you. Sit down with them for a no obligation free visit where they can review your retirement planning. Folks, imagine the consequences of not having an expert give you a second opinion. Retirement planning is important. I believe you deserve to have another set of eyes on what you're doing, don't you? All right, don't want you going anywhere, because coming up we have a terrific question of the week.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Russell & Company is one of the area's premier retirement planning specialists. For a complimentary consultation, call 1-800-392-4378. Russell & Company, helping you create a winning strategy.
Welcome back. It's time for our question of the week.
This week's question is from Helen in Dayton, Ohio. I was watching the show a couple weeks ago, and you were talking about not taking too much risk with your retirement savings. How much risk is too much? Is there a certain percentage of my money that should be safe? How do I figure that out?
Now, this is the question you all should start with when it comes to investing, regardless of your age and background and experience. It all comes down to risk. All comes down to risk. Because if you manage the risk, the gains will take care of themselves. So, terrific question. And here's the most simple rule that you can follow, and it's this. It's the prudent investor rule, and it's been around for over 100 years. You take 100 minus your age. So let's say you're 58 years old. So 100 minus 58, the remainder is 42. That is a percentage. 42% is the maximum a prudent person would have at risk in the markets. And that's the starting point. Now, this should be tailored to you, so it might be a little bit more, might be a little less, but that's a really good rule of thumb. And think back, go back to 2008. Had you followed that rule, would you have lost less? Would you have more now? I'm sure that I know the answer to that one. So that's definitely a good rule of thumb. 100 minus your age, and the remainder is the percentage of how much you should have at risk.
Excellent advice, Rob. And like you said too, it's flexible, but it is a benchmark. And the reason you have to have the benchmark is it's all about controlling that risk. Risk is good. Risk can lead to higher returns, but it can also lead to losses. And so if you're taking 100% of the risk all the time, pedal to the metal, we know the markets go up, we know the markets go down. Having a system to control your risk, actually have something where, at the end of the day, you have a rock or something you can hang your hat on, is very important. Because you know what, especially if you're nearing retirement, you don't have a paycheck coming in every 2 weeks. What you've saved to this point, unless you plan on going back to work, that's always an option, but I don't think it's what you want to do. So make sure you control the risk. That prudent investor rule is an awesome advice, Rob.
Now, retirement's really just freedom.
Yeah.
It's freedom of making the choice whether you want to work or not.
Right.
And that freedom is derived by the choices you make with your investment strategy.
Yeah.
Defense wins the game.
Right.
You're a huge football fan. Defense wins the game. Same thing we talk about investing, especially in your later years of your investing life.
Right, exactly. And that's how you get to Florida. That's how you get to do the things that you wanted to do when you finally retired. Make smart decisions, control the risk, use that prudent investor rule.
Do you want your question answered on Retiring Well? Send us an email to question@retiringwell.tv.
All right, folks, it's my turn. And I got to share something with you here. We're talking about this concept known as sequence of return risk. And here's the thing that bothers me about conversations like this. When all is said and done, a lot of times these conversations end up focusing on the wrong thing. And what do I mean by that? First we focus about accumulation, wanting to make sure that you have enough money to retire. And then we say, okay, now once you've retired, how does this affect your income streams? Well, remember this book called The 7 Habits of Highly Effective People by Stephen Covey? And what did he say that, one of those habits are? He said that you want to begin with the end in mind. Begin with the end in mind. I think that's pretty good advice. So let's think about what's happening here with retirement planning. What is the end in mind? Well, the end in mind is pretty simple. Once you retire, what you really want is to have enough income to support your lifestyle. It's not that complicated. You simply want, I want to say this again because it's really important. You want to have enough income to support your lifestyle. Now, is it okay for that income to be flexible? Is it okay that, gee, if the market doesn't cooperate, you need to reduce your income? No, that's not okay. That's not all right. You didn't work all those years so that once you retire, your income fluctuates with the market, and if the market's good, you're fine, but if the market's not good, you're not. You don't want that. What do you want? Once you're retired, you want streams of predictable and sustainable income that lasts as long as you do. Not only that, you want that income to increase over time, don't you? Why? Because of inflation. All right, so I said, what do we want to do? We want to begin with the end in mind. The end game with your retirement is to have predictable and sustainable streams of retirement income that are not affected by market volatility. So what should you be doing when you're accumulating? Well, doesn't it make sense to work on building those streams of income early? I mean, once you get within 10 years of retirement, shouldn't you start thinking, boy, maybe what I should do here, I'm going to retire here in not too long, maybe I should start building up some streams of predictable and sustainable income that I can turn on when I hit retirement. Wow, what a novel idea, actually planning ahead like that. This is a paradigm shift. Remember, what did I tell you? Why do we do this show? We do this show because I deeply believe, and all the guys, the people who are all the experts on the show, they all believe, all of us believe, that the messages you're getting for your retirement planning are off base. They're not messages, they're designed for your best interests. They're messages, easy for me to say, right? Messages that are designed to line the pockets of the Wall Street firms and the big banks. They're the ones putting out all those messages. Don't listen to them. Not when it comes to your retirement planning. You know, your retirement planning should be about your financial security, not Wall Street's. It should be about making sure that you have a comfortable income no matter what happens on Wall Street. You know, I don't want you to find yourself in another year like 2008. I mean, it's so easy to forget that. I don't want you to find yourself in another year like 2008 where you're retired and then you look at your income and say, holy cow, what happened? My income just got cut in half. You deserve better than that. That's why I keep telling you, you need to pick up the phone. You need to call the number on the screen. You need to talk to a retirement planning specialist because gosh darn it, a different perspective will never, ever be a bad thing for you. And that's our message. Have a great week, everybody.